Okay, right. You can all hear me, guys, yes? If you can all hear me, just it's being recorded. Can you all just can I hear a beep or something from anyone? If you, bear with me, guys. I could hear myself. I need to get YouTube to pause it. Um, I muted it. Okay, I believe you can hear me. Wonderful, wonderful. Pause. One more thing. I had a little thing. Hold on a second, guys. Got me a microphone. Can you still hear me, people? Please, someone send a chat if you can hear me. If you cannot hear me, I'm going to disconnect this thing. Stunning, amazing. Okay, so we're going to talk about options, and but before we do that, I'm probably quickly going to talk about, well, remind you myself, quick intro. I think many of you know me, BK. Um, I've been trading now too long. Anyway, I bought my first stocks in 2008, or 2007 actually. Yeah, 2007 I got my first stock. 2008 we had a market meltdown. I didn't really read much about trading or investing, but I think it was about 2012, 2013. Started doing a lot of reading more, and I just realized they all say the same thing. And then one more thing I started doing was um, I realized that you can't save your way to freedom, if that makes sense. I do a lot of savings. Well, when I was younger, I still do, or try to, and my background is engineering and maths. I went to university 4 times, which means I went to do 4 degrees. From your normal degree to your master's. And my belief is that you have to get that degree first. You have to get the master's, you have to go get a PhD, which I went to do. I went to do the research, etc. But I think I, I didn't enjoy it, to be fair, the work life. And I think the other thing was that speaking of the 9 to 5 life, I was never really successful. So I was doing the odd, or I do the odd buy and hold. And I realized, I learned it from Warren Buffett himself. You can't, save your virginity to old for old age, if that makes sense. I'm going to keep this whole presentation very short. So hence, I think many of you know me already. I do CFD trading. Um, and since I do the CFDs, I, kind of pivot into options as well. So I kind of invest and I trade heavily. I don't pose myself as knowing it all. I don't think anyone knows it all, but at the same time, I think I try. Um, and of course, we do have a mentoring group as well, where we collectively share ideas, etc. I do have multiple strategies when it comes to trading, when it comes to investing, and of course, when it comes to trading and investing, I do trade stocks, commodities, indices. I trade bond. I trade options now. Um, I again, we do it all. So as a group, and that's some of the things I do. And I will say this is how I pay my bills right now, fortunately. So speaking of options, so I kind of like this title because sometimes buying shares is just too slow. And I kind of like that name, Trader BK. Maybe I can call myself that henceforth. Hey, hey, hey. But anyway, um, quick things there that you probably wouldn't see. This is my, just in case, why did I put this picture there? This literally is my trading room right here. As you can see right here, below here is my trading room. In that corner, kind of just sneak that in. I've got a bookshelf here behind me, etc. But anyway, let's go for why we're here. So, um, Options. So what are options and why do we do it? So options are financial contracts. So when you are trading stocks, you're trading the stocks, but this time around you are trading contracts, and it gives you the right but not the obligation to buy or sell an underlying asset at a specific price you can trade. So it gives you the right but not the obligation to buy or sell an underlying asset at a specific price. You can pause it there, and that's about it. So, like I said, I'm going to keep this presentation short. I don't know how many pages we've got, but so why do we use options? I think most of the things you hear from people is that they use it for hedging, um, pardon me, or risk management, leverage, income, and speculation. I'm not firing shots here, but I've got someone, in our group there who trades options and is constantly asking me, so how do you hedge? Because I'm constantly preaching risk management, risk management. And you might think, "Oh, but your style of trading kind of looks like you just spray and pray," which is not what we do. So I'm constantly, you know, um, constantly hammering the term risk management. So you don't necessarily have to use options for risk management alone, but that's one of the reasons why it's being used. And so here, hedging, for example, which we do a lot with our CFD trading, contracts for difference, or spread bets, as we are always say in the UK. So hedging, when you think everything is just going all up, people think, like I always say, stonks always go up, or not just me, everyone says that. So you've got to think, I think I gave an analogy yesterday, or this morning, talking about you got a Ferrari, you're driving it on a fast lane heavily, and you got literally all your possessions in that Ferrari. Listen, anything can happen. You're within seconds of losing it all, and your kids, if you've got one, would have nothing to look forward to and to look up to in terms of inheritance. So you got to hedge. Anything can happen anytime. Leverage as well. I always say with leverage, of course, you can accentuate your win. I, but like I say, it's a double-edged sword. So it gives you the forward and backward. You got to think about it. You could expand your wins at the same time your losses. Again, for income, it's different strategies, and of course for speculation. So this are the some of the reasons why we use options. But the key features that we need to understand are the underlying assets, which we're talking about sorry, I'm looking at a different screen just in case. So the financial assets, which the option is based on, that's what we mean by the underlying asset. It's usually a stock, an ETF, an index. An index, it's a price movement determines the value of the option. Then a call or a put. A call gives the right to buy the asset at a set price, and a put gives the right to sell the asset at a set price. So think about bullish is a call, bearish is a put. So the other way to remember, pick the phone. So a phone call, take the phone call, that is a call, and put the phone down, that is a put. So that's the way I kind of remembered it when I started few years ago. I was quite young in options, I will say. But it's quite a simple strategy, but it will take a while to understand these things. So we talk about contract size. It usually represents 100 contracts, 100 shares per contract. You've got to buy 100. That's one contract. A put gives you the right to sell it, but it's got to be 100. So you control a larger position, but of course with less capital. We've got also expiration dates as well. That's the date the option contracts end. You must act before this date or it expires worthless. All options got an expiry date, and that's the difference compared to the stock you've got. It's yours for life. With options, it has an expiry date, unfortunately. A premium is usually the price that you pay as the buyer or the seller. Sorry, a premium is the price you pay as the buyer when you buy a call or when you or sell a put. So when you buy an option, you pay a premium, or when you sell. So it's the targets. So it's literally the price you pay. And of course, we've got the other thing is that so it's the cost of the contract. The difference is American and European options. European options not as popular, but American options you can actually settle whenever. European options you've got to wait for the expiry dates. So I think American options is a lot more convenient for people, more popular as well. So again, let's just expand a little bit on the call and the puts. Like I said, I'm going to keep this presentation very short. It's going to go over some of you's head. But again, it's not much of a big deal, and that's why we're here. So a buyer has all the rights, which is the call, right to buy the asset. The seller gets all the obligation. You are obliged to sell the asset. And the put, you have the right to sell the asset, and while the seller is obliged to buy the asset from you. So you're selling, someone is taking. You're buying, then someone is selling. Kind of similar to what we do. Literally, the whole concept is all about buying and selling. So the call option gives you the right to buy. I've been saying this for a while now, the underlying stock at a specific price, which is the strike price before a predetermined expiration date. Now, this is an example right here when we're talking about I could expand a little bit more on the call option and the pull option. So when traders believe that the price of a stock will surge over a specific period, they can buy call option to maximize their returns as opposed to simply buying the shares of a stock. So for example, which we're going to go into at some point as well. And again, put option, the opposite, just flip it. So if we look at this example now, this is the price of a stock, and you can see the dates there on the x-axis, the horizontal axis. So, and the strike price, which is the price that's your target price basically. Okay, so with a call option, you believe it's going to go up, and that's the stock. So of course, let's just pretend this the stock here, your strike price. If it goes up, you are in profit between the strike price and the stock price. This should have gone up a little bit, but you kind of get the concept. Again, this is a huge example here. So you've got here a stock XYZ. Should I use ABC now? Because I think, is it Block? They've changed their stock name to XYZ from, changed it 3 times now. Anyway, so stock XYZ is trading near $200 at the end of 2024, 2025. A bullish trader could have purchased a call option on XYZ. Yeah, why did I put 2026 there? Anyway, bullish trader could have traded the stock at a price of 200, but with a strike price of 250. Okay, set to expire in January 20. I should have put 2025 there, but it doesn't matter. So set to expire because we're going to close it in 2025 anyway. Okay. So when you buy the call option, you believe it's going to go up. So you have the obligation to purchase 100 shares of XYZ for 200 per share before the call's expiration date in January. So as XYZ share, the price rockets from 200 to 250, as you can see right there. So it goes. So, and if you notice, there are 2 charts, 2 lines. Okay, so as the option contract goes up, remember with options, we are trading the contracts. I have an agreement to buy your car. It's the agreement that has a price, okay? But all of a sudden, let's just pretend your car is a BMW. I have an agreement to buy your car for $2,000. But all of a sudden, the government is saying we're going to give people, BMW owners, extra £10,000 every month. That price of the contract, the price of BMW is going to go up, the assumed price. Likewise, the contract is going to increase in value. So you are obliged to sell it to me by the date which is expires, okay? And that's literally what it is. So as you can see now, from 200 to 250, this is the stock itself. Yeah, I was right, actually. Sorry, this is the stock. This is just the contract. So I've made about $5,000, okay? So this is the stock here. I called it XYZ, now I'm calling it ABC because I realize XYZ's got a real stock and I don't want people to get confused and start thinking, oh yeah, go and trade this. This is an imaginary stock, by the way. So XYZ is trading at 200. You believe it'll go to 250. So the same price move, way higher return using a call option. So you're trading an option contract. Now you got it for 200 and you sell it for 250. Sorry, you cash out at 250. So this is the real price, because remember, you paid $2 for each contract and you bought 100. So by the time you take away 200, it's 4,800. So you're 2,400% up compared to when you buy 100 and you're only 25% with the real stock. But the difference is with the stock, you own it. With the options, you're just trading the contract. We don't need to own the stock or that we traded. Okay, let's go to the next one. Likewise, the put option, it gives the owner the right to sell the underlying stock at a specific price called the strike price before a predetermined expiration date. So again, Remember, it's similar to what we do. We shorting, aren't we, when we're doing the CFDs? But in this case, with the put option, you are predicting that this thing is going to fall in price, and this is the put strike price. Okay, and now you've got the right to sell. Now let's see what happens. So it's at this price right here, okay? And then, sorry, it's at this price, sorry. And then it goes all the way down. You believe it's going to fall and it falls all the way down. So let's just say it's at this price, but you believe you put, you sold at 200 and it fell all the way there, about 170. That's 170. So your price, sorry, your win is that profit. Okay, but I'm going to look at it in numbers. It's quite easy. So it's traded at 250 at the end of this year, and you believe it's going to fall, and you cashed out at 190. Again, remember, um, when we are shorting, we believe something is going to go down. Okay, so if you sold at 200 and you took your profit at 150, you've made money, that $50 gap. Okay, just focus on this particular writing. So it's traded at 250 at the end of 2024, and then you believe it will decline, and it declined to 190. Okay, and you took your profit. So you've made how much? So again, 250, or yeah, this is my call. Okay, so this is my call option. Where's my put option? So it's trading at 250, 200. You believe you go to 250. Where is my put option? I probably didn't put the put option. I thought I looked at it properly. Okay, that was a mistake. Apologize. So anyway, let's just talk about this. The different prices or different profits target. So he's at 250, you believe it's going to go to 200, you kind of make the same profit. So now this is not good enough to put out there. But anyway, so if you are controlling 100 shares with much less capital, which is why we use options, the same profit you make when it goes up with the call option, it's the same thing you will make with the put option, which is just the flip opposite. I don't think I put the right thing on that slide. But anyway, so a leverage, which is an advantage when you compare stocks and options profits, you control 100 shares with a lot less capital. The max loss is the premium you paid, the amount you risked, that's all you can lose. And you can profit in all directions as well. It's got that flexibility, but this is highlighted in blood, if I can say. The high reward comes with high risk if you use it recklessly. Many people just want to get rich overnight, but unfortunately, there's a cost with it. Like we say, leverage is a two-edged sword. So use options when you want more upside with less capital, and you've got to have a clear plan. The option contract multiplier, like I said, it's 100. So 100 is one contract. So each option contract you buy gives you control over 100 shares of the underlying stock. So what drives options? Number one, a few things drive options. We can talk about the stock volatility, which is, I think you understand volatility both ways, how upside or both, the swim way, upside or downside of a stock, and the stock price relative to the options strike price as well, which we're going to talk about in a minute, I think, and the amount of time until option expiration. So if it's going to expire quicker, of course, the price is going to go a lot higher. Um, Now, if you think about this, speaking of volatility, look at Amazon, look at the range. This is the year range from Amazon, literally ranged from 221 to 200, roughly $20 range. And look at Tesla. Tesla's got a bigger range. So, of course, bigger volatility, then, of course, you expect Tesla to be a bit more expensive when it comes to option price. Okay. And this is what they call the option chain, okay? And look at Tesla again. If you want to buy a call option, look at the market price. I think I took this yesterday. So this is Tesla. A Tesla contract cost about $6.55. But look at Amazon, literally roughly 30 cents. All right. So by the time you buy 100, it's about, remember, times 100. So that's only £30 or $30, apologize. While for Tesla, it's $65.50 because, again, more volatility, more expensive. There's a bit more things there than that. But so there's a bit of a cheat sheet here. So market expectation, you buy a call because you expect the price to go up. And then you expect the price to stay flat or go down. then of course you sell a call. You're expecting there's so many strategies. You're expecting premium, you pay money upfront to enter a trade, or sometimes you buy a call, or sometimes you sell a call when you want to receive money upfront when you want to open the trade. I think some people prefer to receive money upfront. So many ways. With options, there's no cap. The profits increase as the price rises. The profit is unlimited. But of course, when you sell a call, your price is capped. There's a maximum you can make, which is the premium you've collected. The maximum possible loss is the amount that you pay when you buy a call. But with selling a call, the further it goes, the more your loss skyrockets. But even sometimes, especially when it comes to naked option, your loss could be unlimited. So in terms of your responsibility when you're buying the call, you can choose whether to exercise the call, which means you must exercise it sometimes, but you can choose it. Like I say, you don't have to exercise, and you must sell your shares if the option is exercised when you are selling a call. Your risk level is typically lower risk if you're buying a call because it's limited. You know how much you can lose, and that's it capped right there. But when you're selling a call, it's a bit higher risk, and you can lose a lot more than you earn. So again, there are quite some risk of options, which some of them are. Now, let's talk about time decay. So time decay is an unavoidable risk, really, because I think that's so when you are looking at options, there's what they call the Greeks, which I'm not going to cover here. Delta, theta, vega, etc. So when you buy options, they say time decay is an enemy of the option buyer. So the time value of every option's got an expiry date. If you remember, it's got time value factored into it. And typically, the longer they have until expiration, the higher the time value is. So any option that you would own would always be losing some of the value as time goes on. Of course, it doesn't mean that it would always go down in value, but time decay can negatively impact. Sorry about this, someone's just coming in. It can negatively impact the value of any option that you hold on to. Another one is volatility as well. Options prices are higher sensitivity to market volatility. So if you remember April, Liberation Day, and the few days we had, elevated volatility leads to increased option prices, while low volatility can result in decreased option values. Sudden market swings can cause rapid valuations in option prices, and it can impact the trader's position, potentially resulting in substantial losses. Sometimes even you'll be surprised. I think someone came to me today, my DM. The stock didn't actually move, but the option lost about 98% in value, and he didn't understand it. But I think I was actually driving then. But so there's so many factors that move this contract. It doesn't, I think if you think about the BMW example I gave, the value of the car does not necessarily have to diminish, but a few other things, can impact this. Just like your stocks itself, nothing might actually happen, but you've got sentiment around it which drives it. And of course, liquidity. The more the liquidity, the better for you, of course, number one. So in this case, if you are looking into that penny, which is going to be extreme liquidity, you might struggle, hard to sell, etc. Oh, that's about it. I kind of left it short there. And let's take your questions. So I will unmute people and you can ask a question. So, okay, you could all unmute now. So, do we have any question?
Hello, BK. Thanks for your class. I really learned a lot. Yeah, so I have a question. Let's say you buy a call option and
Yeah.
it's going to expire January 2026 next year.
Yeah.
And now let's assume it's Tesla stock, for example.
Mm.
And now Tesla stock goes high, goes like 1,000 US dollars before the contract expires in January 2026. Now, can I sell at this point? Can I sell at this point and take my profit? Or must I wait
Fantastic.
till January
You
before?
you seem to know what you're talking about. It's called exercise. Yes, you can exercise your right. Yes, you can sell it straight away. You can exercise it. Yes. You don't have to. Remember, it's not an obligation. You don't have to. You can get rid of it and just lock your profits in. Even though it's a contract, but you don't have to fulfill that contract. I think there's so many ways to do it as well. And even on the expiration dates, let's just say you're down or you think it might still go up, you could choose to roll it again. So there's so many ways to do it. Sorry, I didn't let you finish, but does that make sense? Oh, you're muted. Okay.
Yeah, thank you. It makes sense now. It makes sense now. So I can sell before January, take my profit, close the deal and
Of
all.
course, of course. Yes,
No,
yes.
no.
Hmm. Talks with me. He wants to talk, I know.
Yeah, hello. How are you?
I'm
Good
very well.
afternoon. Yeah,
Fine.
I just wanted to understand how I can use options to hedge. So I know you mentioned it earlier that
Hmm.
some people use it for hedging. So the example is if I'm owning the S&P 500,
Yeah.
how can I use options to hedge that?
Okay, so beyond the scope of the intro, but let me explain a few options. So with option strategies, we've got, if you're gonna Google 400. So you own your stock, everything has got a downside to it, okay? So number one, you could hedging, you could protect it. Many people don't even know that you can actually insure your stocks. That's one thing. You could actually insure your stocks and literally just collect premium, whereby where your stocks lose in value, you actually get paid the value of the loss. Kind of give that away there. So that's one way. When stocks are so when you have stocks. You buy a call. Some people buy puts in order to hedge as well. That's another way to hedge. There's so many ways to hedge it. You don't want your options get called away. I think one of the most popular ones is the covered call, for example. So you got the options, and so basically you rent it out, okay, for a certain premium. So you actually get paid while you're holding the store. So many people just buy and hold, which is actually there's nothing wrong with it, but you can buy and hold, but actually while getting paid to do that as well. So just so many ways to do it. And of course, sometimes instead of you waiting to collect, so again, you want to buy something at $50, you say, oh, I want to buy this stock at $50. It's not there yet. So instead of you waiting, the money's doing nothing, you could actually get paid to wait. So there's so many ways to hedge, so many ways to collect premiums. So I mean, I use it for three different things. I call it the growth, I call it for crash protection, and of course for income. So three different ways. Okay. Any other question? Okay. Sorry, you guys can mute yourselves just in case. Oh, okay. I don't know. I did say you guys can mute. Hold on. Someone wants to ask me another question. Sorry, hold on. Let me unmute. Yeah. Sorry, bear with me. It's not me. Um, Meeting group. You are muted. I'm trying to do a group on mute. I don't even know how to do it. Bear with me. Sorry, hold on. So I think I've been using this Zoom thing for 5 years.
You did do the Zoom on mute for everyone. I was unmuted.
Oh, how did you? I didn't mute anyone, did I?
You did earlier. It says host wants you to unmute. You just clicked the unmute button. That's what I just did.
Oh, okay. So, guy, if you're muted, you can unmute yourself to ask me a question because I think people are trying to ask questions. Wow. Okay. I think are we good? Thought someone wanted to ask me a question. Doing my due diligence. Okay.
So I have a question. So how is this option group, how is it going to work, please?
Right. Take it. So what the yeah. So yes. This question is actually particularly for us as the wealth hackers. The group of us. So the way it's gonna work, because I think we have an options group now as well. We have a CFD, we have the long-term trading, we have the options group. So the way it's going to work is, I'm just going to explain a few things. Like I said, I'm going to divide it into three, but it's all in one group. Number one, we're going to have, Grace. All right. Please. Right, so we're going to have the income guys, extreme risk. I'm going to create a form, very, very simple questionnaire. So you can look at your risk profile and you will be looking at just collecting income from it, okay? And that's number one. Number two, I will create for the guys with bigger amounts, a bigger portfolio. We'll be looking at crash protection as well. And number three, I know some people. I think one thing I mentioned to someone was my plan. I'm trying to, do a 2-3x strategy as well, which I've got my strategies anyway, and I'm trying to do a 2-3x strategy over a year or two. That's just 18 months. So we're gonna have that as well. So we're gonna have the aggressive guys trying to grow. We're gonna have the income guys, and then we're gonna have the crash protection guys as well, but all under one roof. Okay. I'm not gonna get people to force people. So we're gonna be doing our collective due diligence together, as been doing. I know I tend to do the lead, or I tend to be the lead, and then we can invest accordingly, if that makes sense. I think my how do I say, my main purpose is to beat buy and hold, which which I've been doing anyway for a while now, and I want to maintain that without taking stupid risk or without gambling. I think it's dangerous enough as it is. That's one. What else are we looking at doing? Yeah, I think that without saying too much, but that's literally what I will do. I've got my blueprints written down. Strategy, of course. Like I said again, there's so many strategies to play, but it's all about how do we protect ourselves? How do we consistently make income without losing all to the markets? So the market can be down 10% and you look at your portfolio, probably down maybe 1 or 2%. So kind of things like that is what I'm looking at. If you say you want to make 500% in a week, for example, of course, that's not going to be for you, because I don't even do that. No one can do that. I'm not there to take a reckless risk just to be able to balance things. So that's the way it's going to work. So I think for the first, I put it there in the group actually, the first month, what we're going to do is I'm going to run a workshop, which of course you can watch again, about 4 or 5 sessions, and then we'll take it from there. But unfortunately, guys, if you are Nigerian in Nigeria, you cannot trade options because you just haven't got it. So that's it. And I think it's something many people do not take advantage of, or maybe just just scared of. Okay, I think it's something that's getting a bit bigger. If you can learn about it, I think you could use it to aggressively expand, how much you can make, if that makes sense. So yeah. Don't know if that answers your question, but trying to keep it short. Any other question? I know Yates would always ask me a question. And then she'll still come to my DM and ask again. Okay, if you want to talk, feel free to just unmute yourself and ask. It's meant to be a quick, short, give you an intro to options, and that's it. Okay, if you haven't got any more questions, I'm going to say thanks for attending my TED Talk, and see you in the group. Cheerio. Bye-bye. Bye, everyone. Oh, did I just get something from the main chat? All right, thanks everybody. Bye-bye. So like I said again, I've kind of just given you the surface. There's a lot to it. Oh, no, you can unmute though. Why can you not unmute? Somebody wants to unmute. Mr. Talk with me. Oh, he's left. Anyway. All right, guys. Take care. I'm in the group. We'll see each other later.